Hello viewers, welcome to my channel. I'm Hasham. So now I'm continuing the next problem on ratio analysis, that is problem number 8. So far till the last video I've completed 7 main problems and 16 short problems on ratio analysis. So all the problems are dependent on the formulae. So you must be fully acquainted, thorough. You must remember all the formulas. That means liquidity formulas, leverage or capital structure, activity turnover or profitability. 4 ratios I have given for liquidity ratios: current ratio, quick ratio, absolute liquid ratio, and basic defensive interval ratio. 4 ratios. Out of 4, first 3 are more important. Second, leverage or capital structure, 6 ratios I have given. That is debt equity ratio, proprietary ratio, then capital gearing ratio, fixed assets ratio, interest coverage, dividend coverage. 6 ratios I have given for leverage or capital structure. Then 6 ratios I have given for activity or turnover ratios: stock turnover ratio, receivables turnover ratio, payables turnover ratio, working capital turnover ratio, fixed assets turnover ratio, total assets turnover ratio. 6 formulas. Then lastly, profitability ratios. Under profitability ratios, I have divided into general profitability ratios and overall profitability ratios. General profitability ratios are 5. The profitability which is related to sales or turnover: gross profit ratio, net profit ratio, operating profit ratio, expenses ratio. Then overall profitability ratios. Overall profitability ratios are first one, return on capital employed or return on investment. Then second one is return on total assets, return on equity shareholders fund, then return on equity capital, then return on total assets, then dividend per share, earning per share, price earning ratio, dividend yield ratio, book value per share. In this way, 10 formulas are given for overall profitability ratios. So overall 31 formulas I have specified in video number 2 regarding introduction. So all the problems are dependent on the theory. So my suggestion, if you want the complete knowledge on this topic of ratio analysis, first 2-3 videos are very important. Without watching the first initial videos, you cannot be able to understand this. So my suggestion, be thorough on all the formulas. So go to the playlist of my channel, select the subject financial statement analysis, select the topic ratio analysis, watch the initial videos, you will get the complete command. Then you can watch these advanced problems, main problems on ratio analysis. Now I am going to start problem number 8. But before starting problem number 8, I expect my viewers to have a printout of the problems which I have given in the link under my description. So now I am going to read out the 8th problem. Following financial statement relates to Mayank Limited. Balance sheet is given. Particulars: equity and liabilities, shareholders fund, share capital 20 lakh, reserves and surplus 7,36,000. So 2 items are there under shareholders fund: share capital, reserves and surplus. Current liabilities: trade payable, other current liabilities. We don't have non-current liabilities. Long-term debts we don't have. Directly we have current liability: trade payable, other current liability. Next page, assets. Assets: non-current fixed assets 14,40,000. Current assets are current investment, inventories, receivables and prepaid insurance. We don't have cash and cash equivalent, we don't have. Now this is the complete balance sheet of the company. Now additional information is given: revenue from operations, sales, that is 80 lakh, less cost of operations. Cost of operation means cost of goods sold. So we are using the new terms. Instead of sales, we are calling it as revenue from operations. Instead of cost of goods sold, we are using cost of operations. Then gross profit. When we deduct revenue from operation minus cost of operation, we'll get gross profit. The gross profit is 18,40,000. Less operating expenses 13,60,000, we'll get profit before tax 4,80,000. Less tax at the rate of 50%, 2,40,000. Profit after tax 2,40,000. This is the information given regarding profitability. So we are given the balance sheet, we are given the profit and loss. Now equity shares have a face value of 100 rupees per share. The face value of each equity share is 100 rupees. How much is the share capital? See the first item, share capital is given 20 lakhs. The total share capital is 20 lakhs and the face value of each share is 100 rupees. So 20 lakh divided by 100, you will get 20,000. That means the company is having 20,000 equity shares of rupees 100 each. So 20,000 into 100, you will get 20 lakhs. That's it. Now calculate the following ratios. A, B, C, D, E, F. So total is 6 ratios we have to calculate. One by one we'll calculate. First, current ratio. Current ratio. Every problem, most of the problem we came across this ratio. Very frequently asked. Current assets. By current liability, very easily you can calculate. Current assets, specifically in the balance sheet, all current assets are given. Current investment, inventories, receivables, prepaid, insurance. Now you add up the respective values. Current investment 2,40,000, inventory is 9,60,000, receivables are 7,20,000, prepaid insurance 24. Add up 19,44,000 is the total current assets. Now current liabilities consist of 2 items, trade payable, other current liability given in the balance sheet. Take the total 6,48,000 current liability. So current assets, current liability both we have. So CA by CL 19,44,000 divided by 6,48,000. 3:1 is the current ratio over. First ratio we have calculated. Second one, it is asking you quick ratio. The formula is quick assets by current liabilities. Current liabilities already we have 6,48,000. Quick asset we don't have. So how to find out quick asset? In the previous problem, already so many problems we have applied. Quick asset is equal to current asset minus stock minus prepaid expense. 2 assets you deduct from current assets, you will get the quick asset. So what is the total current asset? 19,44,000. From 19,44,000 I deduct inventory. Stock, inventory means same. How much is the inventory? 9,60,000. So deduct 9,60,000. Then deduct prepaid expense. Prepaid expense are 24,000. Deduct 24. So ultimately quick assets are 9,60,000 rupees are the quick assets. Current liability already you have calculated 6,48,000. So 9,60,000 divided by 6,48,000, 1.48:1. This is the quick ratio. 2 ratios completed. Now third ratio, it is asking you stock turnover ratio or inventory turnover ratio, means same. The formula is cost of goods sold or cost of operations. The cost of operations divided by average stock. But in our problem, we cannot calculate average stock because opening stock is not given. Closing stock is given. Closing stock is the inventory which is appearing in the current assets. Under the current asset, you will find inventory, that is the closing stock. So we'll use alternative formula, cost of operation divided by inventories, closing stock. The cost of operation 61,60,000 given in the problem. Inventories are 9,60,000. So 6.42 times. This is the stock turnover ratio. Next is operating ratio. So operating ratio, cost of goods sold plus operating expense divided by net sales. But here we call it as cost of operations plus operating expenses divided by revenue from operations into 100. Into 100. So here cost of operations 61,60,000 given in the problem. Operating expenses 13,60,000 given in the problem. Revenue from operation 80 lakh, that is also given in the problem. Simply you substitute the values, multiply by 194%. The only thing is you must remember the formula. All the values are given in the problem. Substitute the values, you get the answer. Next one, debtors turnover ratio or receivables turnover ratio means same. The net credit sales divided by average receivables, average debtors. This is the formula for debtors turnover ratio. Net, but due to lack of information, credit sales we don't have. Only sales we have. Sales are nothing but revenue from operations. So when we cannot calculate credit sales, take the total sales. Assuming the total sales itself are the credit sales. So here, How much are the revenue from operation? 80 lakh rupees are the revenue from operation. Divided by average debtors. Average debtors we can calculate when we have the opening debtors and closing debtors. We don't have opening debtors. We have the closing debtors. What are closing debtors? Receivables appearing under the current assets. Receivables appearing under the current assets are the closing debtors. So we'll take the receivables. So 80 lakh rupees is the revenue from operations and receivables are 7,20,000. So receivables turnover ratio, debtors turnover ratio is 11.11 times. That's it. One more ratio it is asking you, market value of the share if the price earning ratio is 10 times. This is the first time we are coming across this point. That means we have to find out the market price per share if the price earning ratio is 10 times. So one formula is the price earning ratio. The PE ratio formula is market price per share divided by earnings per share. P stands for market price, E stands for earning per share. Market price per share divided by earning per share. So here P ratio is given in the problem 10 times. Market price per share we have to find out, whereas earning per share is not given. So first we determine what is the earning per share. Once if we get earning per share, easily we can find out the market price per share. So how to calculate earning per share? Remember the formula. In the second video I have given the list of all the formulas. In that, earning per share EPS is equal to profit after tax minus preference dividend divided by number of equity shares. PAT minus preference dividend divided by number of equity shares. You will get EPS. Now PAT, profit after tax, 2,40,000 given in the problem. Preference dividend, there is no preference share capital. When there is no preference share capital, no preference dividend. The preference dividend is 0. But number of equity shares is not given directly in the problem. It is saying total equity share capital 20 lakh and the face value of each share is 100 rupees. Face value of each share is 100 rupees. So 20 lakh divided by 100, 20,000 shares. The company is having 20,000 shares. Number of equity shares is equal to 20 lakh divided by 100, 20,000 shares. Now we substitute PAT minus preference dividend divided by number of equity shares. 2,40,000 PAT given in the problem. No preference dividend divided by 20,000 shares. You will get 12 rupees. What is this 12 rupees? EPS, earnings per share. So we got the earnings per share. Now we substitute in the formula of PE ratio. You can see PE ratio is equal to MPS by EPS. MPS stands for market price per share. EPS stands for earning per share. The PE ratio is given in the problem 10 times. Price earning ratio is 10 times. So in place of PE, I am writing 10. Market price per share we have to find out. Earnings per share just now we have calculated 12. So EPS 12. Now we'll make a cross multiplication. MPS into 1 is MPS. 10 into 12 is 120. So MPS is 120. What is this MPS? Market price per share 120 rupees. Got it. Finished. So this is the end of problem number 8. Now I am reading out problem number 9. See. Following is the information pertaining to Satyanarayana Limited as on 31st March 2017. Equity share capital 50,000. 8% preference share capital 10,000. General reserve 32,000. Profit and loss account 20,000. 6% debentures 20,000. Sundry creditors 30,000. Fixed assets 87,500. Non-current investment 25,000. Inventories, receivables, bank balance. These are the complete values given in the problem. The directors intend to transfer rupees 5,000 out of current year's profit of rupees 20,000 to provision for taxation. The current year's profit is 20,000. Now directors want to transfer 5,000 rupees to provision for taxation. So out of 20,000 rupees, 5,000 rupees are transferred to provision for taxation. The profit after tax will be 20,000 minus 5,000. 15,000 will be the profit after tax of the current year. You are required to calculate return on capital employed ratio, current ratio, and return on equity shareholders fund. Only 3 ratios it is asking you to calculate. First ratio, return on capital employed. Return on capital employed, ROCE. In the previous problems also we have applied this formula. PBIT divided by capital employed into 100. Because it's a profitability ratio, we multiply by 100. So we need 2 things, PBIT and capital employed. Now you must remember how to find out PBIT. PBIT is equal to PAT plus tax plus interest. Already in the previous problems we have applied. PBIT is equal to PAT plus tax plus interest. PAT, profit after tax, is 15,000. Just now I told you in the paragraph it is given the company earned a profit of 20,000. From this 20,000 the directors wants to transfer 5,000 rupees to provision for taxation. So after deducting 5,000, 15,000 is the profit after tax. So PAT is 15,000. Tax, how much provision for tax created? 5,000. So 15,000 plus 5,000 plus interest charges. Now see here, interest charges directly are not given in the problem, but one thing is given. There is a debentures. On debentures the company will pay the interest. What is the rate of interest on debentures? It is given 6% debentures rupees 20,000. It is given 6% debentures of rupees 20,000. That means interest has to be paid at the rate of 6% on 20,000. So 6% of 20,000 comes to 1,200. So 1,200 rupees are the interest charges. Now 15,000 plus 5,000 plus 1,200. 21,200 is the PBIT, profit before interest and tax. Now I need capital employed. Remember the formula for finding out capital employed. Equity share capital plus preference share capital plus general reserve plus profit and loss account plus debentures minus fictitious asset, but we don't have fictitious asset. So debentures will also be included in capital employed. So equity share capital plus preference share capital plus general reserve plus profit and loss account plus debentures. All the values, amounts are given in the problem. 50,000 plus 10,000 plus 32,000 plus 20 plus 20. 1,32,000 is the capital employed. Now we got, easily we can substitute return on capital employed. Return on capital employed, ROCE, is equal to PBIT. PBIT 21,200 divided by capital employed 1,32,000 into 100. 16.06%. That is the ROCE. That's it. One ratio completed. Second ratio, it is asking you to calculate current ratio. Current assets by current liabilities. So current assets are inventories plus receivables plus bank balance. Only 3 current assets are given in the problem. So we add up 30,000 plus 13,500 plus 7,000, 50,500 current assets. Now current liabilities are 2 items, that is sundry creditors and provision for taxation. Creditors are given 30,000 and provision for taxation 5,000 given in the last line. The directors wants to transfer 5,000 rupees provision for taxation. So 35,000 is the current liability. Now substitute. Current ratio 50,500 divided by 35,000. 1.44:1. This is the current ratio. Now last ratio, return on equity shareholders fund. Return on equity shareholders fund. This formula is also there in the list of the formula. PAT minus preference dividend divided by equity shareholders fund. This is the formula on return on equity shareholders. PAT already we know given in the problem. 20,000 rupees is the current year's profit. From 20,000, 5,000 rupees director transferred to provision for taxation. So PAT is 15,000. 20,000 minus 5,000, 15,000 is the PAT. Then equity shareholders fund. We need equity shareholders fund. There is a difference between shareholders fund and equity shareholders fund. If we want shareholders fund, we include both equity as well as preference, because both are shareholders. So if we calculate shareholders fund, then we include both. But when we calculate equity shareholders fund, we will not include preference. We will not include preference. So here we need equity shareholders fund. So equity share capital plus general reserve plus profit and loss account. We are not including preference because we need equity shareholders fund. So equity shareholders fund are 1,02,000. Now preference dividend. Now it is given in the problem. There is preference share capital 8%. 8% preference share capital of rupees 10,000. That is given in the problem. So 8% of 10,000 comes to 800 rupees. This is the preference dividend. All the three items we have. Profit after tax, preference dividend and equity shareholders fund. All the three items we have. So 15,000 profit after tax, 800 preference dividend divided by 1,02,000 equity shareholders fund into 100. So it comes to 13.92% is the return on equity shareholders fund. That's it. So in this video, I have explained you the 8th and 9th problem. So in this video, all the formulas are similar, but 2-3 formulas I came across first time, which we have not seen in the previous problems, like PE ratio, price earning ratio, and also return on equity shareholders fund. So focus on those new formulas, new points in every problem we are coming across. So I have explained you each and every point, every formula in detail. Hope you are satisfied with my lecture. If you are satisfied, give a like to the video. Share my channel in your group, in your friend circle, so that more students can watch the video and enhance the knowledge. Give your comments on these videos. And lastly, don't forget to subscribe my channel if you have not yet subscribed. We'll continue the next problem in the next video.